And one of the things that we haven't spoken about is hedging. Hedging, I suppose, your currency exposure, exposure to economic growth, whatever it may be. And so the one question that has been asked is, in terms of this one facility, which is this $306 million loan, are there options for hedges as African economies are volatile, for example, on the interest rates? Are the conditions to fix or have caps or collars based on certain outcomes?
No, interest rates are a key thing we look at, obviously, as FX risk, and the same risk that impacts Grit and their returns from tenants and their portfolio impacts potential debt repayment from our side from the receipts they get. The tenant base is very focused on dollar earning tenants. You'll have a lot of multinational type tenants so that they have access to dollars from a global perspective, even if the jurisdiction that they're currently operating in has some challenges, for example. So your strong tenant profile helps mitigate some of that dollar risk specifically, at least from a receivables or cash flow perspective. And then marrying that across with the debt costs and interest rates going up and down. I mean, all the banks have dedicated teams focusing on these types of solutions, and we engage with clients. But there are a few different sexy structures the guys put together. And yeah, that's outside of my scope of day-to-day expertise, but that's, I guess, a basic overview of it.
You know, we also hedge to an extent on a natural basis because our dollar-based tenants are obviously linked to inflationary increases. So to an extent, we are naturally hedged, but we do take out these instruments to hedge ourselves. I think currently our US dollar debt sitting at an 80% hedged level. So we constantly look at these instruments that's available and do assessments on an ongoing basis.
I mean, Leon, was that the primary kind of, one of the, I suppose, the founding principles of Grit was that you would have tenants who paid in hard currencies?
You don't want to have a dollar debt versus a kwacha income stream. That's where you open yourself up to undue risk. So in all of our properties, that's why we have the currency of the debt in the same currency as the lease streams. And that's why we look at certain artificial products like cross-currency swaps, where a portion of our portfolio is actually in euros. And naturally, we've tended to have higher gearing on our euro assets because we ultimately report in US dollars. So any mismatch there creates a transaction that you have to book on your balance sheet, which either creates a profit or loss. And you need to control this level of volatility. Cross-currency swaps are one of the hedging mechanisms that we've put in place for this, but it's also just creating the more natural hedges, which are ultimately going to be cheaper, is matching your euro or your other currency debts to your other currency assets, which creates that natural hedge situation, which is ultimately one of the better ways of doing it.
Bronwyn, maybe going back to you, is this something that you've had to work hard to explain to your investors?
It goes to the fact that this is Africa, and when we're sitting in the UK, and actually predominantly our UK investor base is not actually emerging market investors, they are looking for income effectively, and they're looking for hard currency returns. So the management team actually has to spend a considerable amount of time with our investor relations team really speaking about the Grit investment case, because automatically when people see Africa, it gets tainted with one brush. So you have sort of a fallout in certain countries, and even what we've seen from a macro perspective in South Africa, and then the continent gets tainted with one brush. So it's to explain the differences between all the geographies. It's also to explain that we are not exposed to local currency risk. So that is obviously a very large factor in relation to people automatically seeing an Africa business and saying that there is local currency exposure. So it's the hard currency leases. We've created a product which is Africa. It's the growth story of Africa, but it's fairly mitigated because of the fact that it's predominantly hard currency, it's multi-geography, it's global tenants, it's multi-asset class. Our leases are linked, as Jaco said, in relation to inflationary increases. It's about simplifying the story. Okay, so it's about saying, what is Grit? You know, we are here to service the real estate needs of global tenants who can service hard currency leases. We want to control and give them the whole value chain of real estate from start to finish, from building their buildings to managing their assets. We want to collect hard currency rentals, and ultimately we are long-term holders of real estate. So, you know, Juliet, it's a continuous education, re-education, especially to investors that are not emerging market investors. But to be very honest, we will continue to tell the story because of the fact that people are looking for good alternative investment. What has been experienced in Africa has actually become a global issue. There's our global macroeconomic challenges, and people are looking for mitigated, good alternative investment stories with very, very heavily invested management teams. And that is what GRIT is.
Well, for GRIT, it certainly anchors how we think about maturity risk on our debt. What it does is it demonstrates further commitment from the banks and from GRIT on the continent. It allows us to unlock our strategy, which will be impact investing across asset classes which are undersupplied on the continent and where we see long-term returns that can be generated from these asset classes.